If you've been watching the news, or honestly your portfolio, you probably know that bonds are experiencing one of the worst drawdowns in over 40 years. In fact, 2022 was the worst year ever for U.S. bonds. That's ever, at any point in the United States history. But bonds are supposed to be the safe choice. So what's going on? Today, I want to give you a basic understanding of how bonds work, because I think it's important for every retiree and for every investor to have a basic understanding. And I want you to understand why they've been going down in value over the past few years. I'm also going to explain why I stopped using bonds in almost all of my client portfolios a few years ago, which caused a few people to look at me a bit funny. And I'm going to tell you why I'm starting to think about using bonds again. But first, my name's Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Now, at the most basic level, the reason that bond prices are collapsing is because interest rates are rising. And when interest rates rise, it destroys the value of bond fund. And so over the past few years, instead of providing safety and protection, bond prices have actually crashed. In fact, if you'd put $10,000 into the aggregate bond market in 2019, and then come back this week to look at your portfolio, all excited to open it up and see how great your bond portfolio had done, you'd have less than $10,000 today. On the other hand, if you'd invested in stocks, you'd be up by a significant amount of money. So to help make this a bit clear, I'm going to use a metaphor, and I'm going to use the illustration of a seesaw. I don't even know if those are legal anymore, but when I was a kid, we had these seesaws. You put something heavier on one, heavier person on one side and a lighter person on the other side. It'd go down like this, and then you tried to balance the weight out so you could go back and forth. Well, bond prices work in the same way. As interest rates move up, bond prices move down. And as interest rates come down, bond prices go up. So it's just kind of back and forth. The question is, why? So let me explain how bonds work. Now, this is a very basic explanation. And so if you are a bond expert, you are probably going to be throwing things at the screen and telling me how I've missed things. You can tell me in the comments below how many things I got wrong. I'm not trying to give a complete explanation of how bonds work, but I do want you to have a basic understanding. When you choose to own bonds, you're basically choosing to loan companies or governments money as opposed to being an owner. So for example, equities is when you actually own a portion of a company, but bondholders decide that instead of owning a portion of the company, they want to loan the company money through bonds. So the process tends to go something like this. A company needs to raise cash, or a government needs to raise cash. So they'll do a bond offering, and typically they'll do it in increments of $1,000. So that's the par value. Back in the olden days, you'd get a literal bond certificate that would show that you owned those bonds. And those bonds typically had a coupon rate or a yield, what the interest rate that would be paid out on those bonds would be. Typically, it paid twice a year. In fact, those old-fashioned bonds would have coupons attached to the bottom of it, one for each scheduled interest payment, and they were literally just printed on the certificate. And the date the coupon was due, the owner would detach the coupon, called clipping a coupon, and present it for payment. So typically it's $1,000, as I said, par value, and they would pay twice a year. So if the coupon rate, which is basically the yield, is 5%, then twice a year, you'll receive a bit of income for the bond. So in this situation, if the rate is 5%, you'll receive $25 twice a year for $50 a year in interest. And the coupon rate is partially dictated by credit risk. The safer the bond issuer, say the federal government, the less interest you're going to receive, while junk bonds, which are the riskiest, pay the highest yield. So far, so good. Is everyone tracking? Now, bonds have different durations, basically the time that the bond issuer has to pay you back the par value. Let's say you have a 5-year bond that pays 5% interest. So for the next 5 years, twice a year, you'll receive $25. So here is an awful visual representation. I apologize, but I figured I'd try to make it as visual as possible. So you have $1,000, you buy a bond, and then and it's a 5-year bond at 5% interest. The coupon rate is 5%. So over the next 5 years, you're going to receive 10 interest payments, $25 each. So 2 a year. So $25, $25, $25. And then at the end of this time period, the bond issuer, the company or the government's going to give you back the initial investment of $1,000 and say, thank you very much. But here's where things go wrong. You bought this bond and you're clipping your coupon at 5%. You're as happy as you could be. But then the economy changes and interest rates go up. And so now people are getting paid 10% for holding bonds. Well, that's a bummer because you're stuck for the next 5 years getting 5% when everyone else is getting 10%. And then here's where things get even worse. You need your original investment back. You need that $1,000 cash back. So you need to sell your bond to somebody else who's willing to buy it. Well, if all the other bonds are getting 10%, no one is going to pay you $1,000 to buy this bond that's paying a 5% yield. So you have to sell the bond that you bought for $1,000 at a discount. And that discount will essentially make future yields equivalent to the 10% that everyone else is receiving for their bonds. So if 10% would be $100 a year in yield on a $1,000 par value, which is going to then lower the price of your bond, and that might make it worth, say, $800, $750 to $800. I'm not going to do the math here. But the further out you go in duration, the more that initial par value or that initial bond value that you purchased is going to drop, because whoever's purchasing it wants to make sure that their yield to maturity is similar to what they could get for buying a bond at the current rates, which is 10%. That gets a little complicated, but basically all you need to remember is that as interest rates rise, the value of your bond decreases, and the longer the duration of the bond, the more that the value will decrease. Now, if you had held the bond to maturity and had it sold, you'd receive 5% a year as you were originally promised, and you'd receive your $1,000 par value with no lost value. But if you need to sell your bond early, then that's where you can end up losing money on bonds. As interest rates go up, the price of bonds go down. And most investors today don't own individual bonds. You don't own bonds in GE or AT&T, partially because there's more risk that you take when you own individual bonds, with the exception of government bonds. And most investors today own bond funds, which have a variety of durations that are mixed together. So as interest rates rise, the very thing that we love in our bank account causes our bond funds to decline in value. But now let's change course for just a moment. And I want to talk about retirement in bonds, and particularly I want to talk about the 60-40 portfolio and ask why it's been popular for so long and why it worked for so long. Why did it provide protection for so long? So let me show you a chart. In 1982, bonds hit around 16% yield. Now, the Fed chair at the time was a guy named Paul Volcker, and inflation was out of control. If you lived through this period, you remember it was much worse than our current inflation crisis. And so the only way that the Fed chair, Paul Volcker, could get inflation to come down was to raise interest rates so high that it basically just brought the entire economy to a screeching halt. And then over the next 40 years, you had the interest rates coming down from that 16% peak, and they end up coming all the way down to almost zero. And so as the interest rates come down, the bond prices begin to move up. And you had the introduction through PIMCO and other places of the total return funds. So you could participate not only in the yield, but also in the price movement. And so most Americans stopped buying bonds directly. They stopped doing bond ladders and all the things that they'd done. Historically, what you'd do is you'd have a bond ladder, bonds expiring in 1 year, 2 years, 3 years, 4 years, and 5 years. And now they were just buying a bond fund. And as interest rates dropped, the bonds went up in value. Everyone was happy. But as you can see on this chart, the coupon rate or the yield basically hits zero. And this is why I stopped using bonds a few years ago, because there was nowhere for the yields to go but up. And what happens as yields go up? Bond prices go down. Honestly, this happened much faster than I expected it would, but I knew that there was no place for bonds to go up. I mean, bonds could go negative. They did in a few countries, but even if they'd gone negative, that would have been fairly short-lived. And then eventually bond yields were going to have to go up, and that was going to cause bond prices to begin to fall. And honestly, they'd come down faster and more dramatically than I would have even predicted. So here's the big question. Now that rates have seemed to stabilize, it doesn't seem that they're going to be going up a lot faster. Does it make sense to reconsider bonds? And if so, what should we look for? And so for the first time in a long time, I've started to consider using bonds again. And I'm not going to give you investment advice and tell you what kind of bonds to purchase, but let me give you a couple quick pointers. The shorter the duration, the safer the bond, or the less impacted it is by rising interest rates. The reason is because the longer you're locked into a bond price, the more the value is going to come down. If you're locked at 3% for 30 years, no one's going to want to buy that bond from you unless you're willing to take a steep discount. On the other hand, if you have an ultra short bond fund, it's just a few weeks or a few months, it's not going to be impacted by the interest rate shift. So that's why you see so much money flowing into ultra short bond funds. And so the shorter the duration, the safer the bond, because the less impacted it is by rising interest rates. So if you buy an ultra short bond fund, there's almost no interest rate risk. But there are other risks because you're not guaranteed that that rate will go up forever or will stay there forever. And if rates begin dropping again, saying that, say the economy begins to slow down, which is very possible, and the Fed has to cut rates, then your bond yield will drop. You won't lose your par value, the amount of money you put in, but the yield will drop. So you're no longer receiving as much income from the bond. So the other option is you could go out further in duration to say intermediate term bonds or long-term bonds. And the farther you go out, the longer you lock in a higher yield. And interestingly enough, while you have more risk of that bond fund going down, you also have more buffer for your portfolio because the longer you go out, the more volatile the price. Well, why would you want that? Well, because if the economy slows down and we go into recession, which is quite likely or quite possible rather, those rates will come back down and your bond prices will go up. And if the economy slows down, stocks will probably begin to drop again. And if stocks begin to go down, this bond fund very possibly will go up when rates are cut. And that's going to provide you some much needed buffer in your portfolio. But there's a flip side. If rates go up, then it's not going to provide any protection at all, and those bond funds are going to continue to fall in value. And that will happen. Rates will continue to go up, primarily, in my estimation, I'm not an economist, but rates will only go up if inflation isn't tamed. So if inflation isn't tamed, then interest rates are going to continue going up, bond prices are going to continue going down. And so you probably also want to have a diversifier in your portfolio that provides some interest rate protection. And there are a variety of products you could use. You could use government tips. You could also use some managed futures. You could use commodities. So there are a number of diversifiers that you can put in there that will provide some inflation protection. If I was putting together a portfolio today, I want to have some equity. I want to own companies that are going to grow and be a part of the future, because I want my assets to grow in value. But I also want to have some protection from a slowing economy. And the best way to do that is through bonds, because if the economy begins to slow, interest rates will come down and those bond funds will go up. And in addition, you are locking in a higher yield. You're getting close to 5% in some of the longer duration bond funds now, which is really attractive. And then finally, I would also want some protection against inflation, because if inflation spikes back up, you could see stocks go down, at least in the short term, and bonds funds could go down. And so you want to have a sliver of protection either through commodities or managed futures or something to diversify that out. And I think that's a shortcoming in many portfolios that are being created, is that these 60-40 portfolios have stocks and bonds, but they're not properly insulating against other potential risks. Okay, I'm going to leave it there for now. For the two of you who are still watching, thanks for watching through the end. And if you're looking for a financial advisor to help you navigate through all this, I'd love to work with you. You can schedule a free retirement assessment in the show notes below. And also, you can watch this video that just tells you a little bit more about why our firm exists.